Good afternoon, everyone. Welcome back to the Schwab YouTube coaching channel. Our next topic is after the close, and I am your host, Kevin Horner. Thanks for being here today, everybody. You know, not every day does the market offer us opportunities that we might be very comfortable with. Sometimes we have to scour the market to locate different opportunities. You know, I found this out today in prep for this class that evidently many of my fallback scans just weren't generating trade ideas for us today. And it's a good reminder that not every day is a wonderful setup day. And sometimes it's incumbent on us traders to be a little more disciplined and maybe not take a trade, or maybe be patient, wait till the next day, or to scour the market in ways that we otherwise haven't, just to kind of get a better feel for things. So we're going to work through some of my thought process in doing that today, because for some of you, you might find that intriguing. You know, hey, what was Kevin thinking when he was going through the prep for this class? What happened? How did we come up with symbols? Turns out we didn't have as many on the bullish side as I had expected. So we're going to work through that today. Of course, we're going to start with a brief look at how the market closed. So we'll hit up our major indices, work through some scans with all of you. I'll share some of those scan details, of course, and then we will work with our example portfolio to make sure that we are addressing example trades live and in class. So say hey to Mike Fairborn there in the chat today. He's stepping in for our friend Barb Armstrong, who's out today. Mike and I can both be followed on X, Mike Fairborn CS and Kevin Horner CS. X is definitely the best place to meet up with us coaches when we are not hosting or providing chats support here for all of you. So if you'd like to see what we're up to throughout the week, that's the place to do it. Try to post for you there throughout the week with some notable charts. At least that's my go-to. Mike is keen on reminding you that he loves to be out and about on that bike of his, and he wants you to see the beautiful scenery as well in the Utah area. But of course, Mike's going to give you a bunch of great insights on the market and charting and so forth. So please give us a follow there. All right, let's get to our disclosures briefly, and then we'll jump right into the chart. So first of all, remember that our discussion here is exclusively for your information and your education. We do not make recommendations nor endorsements for a specific approach to trading the market. We will talk technical analysis. In doing so, we remind you it's just one piece of your decision-making puzzle. We do not encourage you to base decisions exclusively on what you get from technical analysis only. Additionally, we're going to cover perhaps some options today. Just remember, options carry a higher level of risk, are not appropriate for all investors, and you do need to be previously approved in order to trade options. So make sure that you are running through your requisite pre-work so you are approved on the accounts in which you would like to trade those options. You can carry various levels of authority, trade authority for options on each of those individual accounts. And so as I mentioned, we're going to start us off today with just a quick start at the look of what's going on in the S&P 500 here, where, you know, these lines that I drawn in were kind of important a couple of weeks ago, maybe. What matters perhaps more now might be the break of our downtrend line through here. So if I was to just redraw this, and just make note of the fact that we have stayed above our downtrend line now for about 2 weeks after breaking it. We've also made a series of higher lows along the way. If I zoomed in there, let me show you that, which I think is kind of notable because that's a pretty standard technical analysis concept, right? We want to make higher lows, and if we're making higher lows, we're probably making higher highs, at least in the short run. So this kind of has the makeup of a new potential channel, like so. And the fact is, we're above the 20 and the 50-day moving averages here. So from a trend standpoint, many traders are probably feeling a little bit more confident now that we have moved through this important level, this next white line that I'm going to snap here for you. This was basically the top of that channel, and it was important that we moved through it. Well, we gapped up that day. That was the 26th from the 25th of November, and we've just kept it. So even if we break this channel to the downside, and certainly looks like today could be one of those days where maybe we don't hold the channel today, if we came back for a revisit of what I'm now going to color as my green line, former resistance, now potential support, some traders would view that as perfectly comfortable, perfectly within reason, and a potential area to expose new money to the S&P 500 if we retreat, test that level for support, and hold it, move off of it. So if we come consider that a successful test of support in the vicinity of that 50-day moving average at 67.52 today. That becomes a proper area for potential support as well. Otherwise, moves underneath that green line could easily mean we have to go back and test that 65.40. And, that would be fine too, depending on your process and your time frame. But, we're not going to enjoy a move of 200 points to the downside in the SPX. So that's why some traders would look to lighten up maybe under that green line. They might get a little bit more defensive. Now, today, the NASDAQ is going to look a lot similar. Those lines are very similar in scope as well. Notice the 20 and the 50 virtually on top of each other there. So we've got confluence of support at that level. If I drew my line from the prior peaks, former resistance, now potential support, the same thing lines up. So what do we get? More confluence of information at that level. That green line can be supportive on our NASDAQ 100 as well. And then recently, that is, the Russell has rallied back aggressively to the all-time highs. Notice all of those tails up there, everybody. Tells us a couple of things. One, that we're not yet capable of pushing the small caps through that ledge. And two, that if we do push through that ledge of resistance, boy, it could be exponential to the upside. It would be a significant development. A lot of traders would look at this as a potential for a pretty strong rally. And we're not going to get too cute in here, but just to draw the line down, the height of the range that we are looking at here in the Russell, this could give an approximation as to how high it could move. And that would be a pretty good development for the small caps, wouldn't it? If we suddenly found ourselves up in the neighborhood of say 2,800 almost, that would be a fantastic development. Now, we're not going to say that that's a guarantee. No measured move target as this is calculated is a guarantee to be achieved. But you can see that if we broke to the upside, you can see why bullishness would prevail in small caps. And of course, the reason for a lot of this bullishness in small caps is tied to the narrative and discussion around the potential for rate cuts tomorrow. We are going to be hearing from the Fed tomorrow. Mr. Powell will speak after the announcement of policy change. So we do have the opportunity for a move one way or the other. Expectation remains for a rate cut tomorrow. Again, the time frame is 2 p.m. Eastern for the cut, for the announcement of policy decision, I should say. It is traders positioning at 90% likelihood of a 25 basis point cut, but that doesn't mean we get it. And of course, if we don't get it, the reason for a lot of the rally we've seen from these lows from November 20 would be immediately washed away. And if that were to occur, of course, we could have a very difficult day tomorrow. So not just tomorrow, that could be a difficult day tomorrow into the weekend as well. So then that doesn't imply, I can't tell you that even a cut is going to result in an upward move, right? So we have to use and be aware of all of these as possibilities. So just something to keep in mind. Getting a little bit of leadership from small caps. Broadly, we enjoy that when small caps are leading. It does speak to a little bit of the health there, but by no means the only thing we can do, but certainly appropriate when considering where might we be looking here of late. Now, usually what you all know that I'm going to do next is jump to our Market Watch tab and try and take a look at our relative strength returns. We see that technology is right back at the top. This time last week, we were about the halfway point on a relative strength basis. So tech was undergoing a bit of a drawdown and pullback, and there's nothing wrong with that, but it just meant last week we weren't getting as much leadership. And today I thought, well, let's go in and look within the NASDAQ 100 or even the small caps or the S&P and look for bullish trends, which I'm happy to do. But I really found that I wasn't getting the bullish trends that I expected. Normally, I would go in and look through the tech sector itself. I would eliminate the other sectors just to lean into technology, being that's our leader. But I didn't have a whole lot of securities finding my major levels, that being like a 20-day moving average or even a 50-day moving average. So I found that to be a little instructive. And what that told me was that I had to keep digging, and I might find opportunities, but they aren't going to necessarily be the opportunities that some traders are most comfortable with. Now, if you're the trader who is working to be as disciplined as possible, and maybe you're the trader who wants to be buying on successful support tests of a 20-day moving average or perhaps a 50-day moving average, well, I found that they were very difficult to locate. Let me show you what I'm talking about. I'm going to jump to my scan tool, and I'm going to put in, let's go ahead and load something like my 20-day moving average pullback. And so ultimately, I'm just looking for stocks who are currently or finished today above their 20-day, but their low of the day was below the 20-day. And these are uptrending stocks. So we've got a 50-day moving average above a 100-day moving average, and et cetera. So when I did this to scan in the S&P 500, though, I found very few, right? And really only one in technology. Now, this is a little different than it was at the close today, or prior to in my prep work. I did find HCA to be a little bit interesting, and you'll see why here. So look at HCA. You've got that 20-day in orange. You can see we made a peak, and we've just pulled back to the 20-day. Intraday today, we were below it, but at the close, we were above it. That's what some traders would call a successful test of the 20-day moving average. That's why HCA made it. A couple of the other securities on that list, though, take a look at Exxon. So quickly, here's Exxon. I mean, could you make a trade out of an Exxon chart? You probably could, right? But at the same time, it's also a little bit choppy and messy. There's a lot of tails in here. Maybe if we paired this back, we could see that on the weekly moving average. Let me put my study set in here, my weeklies. Sure looks sideways, doesn't it? I mean, essentially, Exxon has just basically gone sideways for the entirety of this. Now, that's notable because if you're a technician, what we want to see are movements outside of consolidation windows when we can start looking for new trend situations. If Exxon can break to the upside, well, then many a trader is going to suggest it can start to trend from there. The interesting thing to me is we've been in this space, in this rectangle, since October of 22, and here it's 25 in December. So we are looking at a 3-year range, basically a 3-year 20-point range or so, about 25 points, let's call it. So 3 years, 25 points, it's really just gone sideways. If it can break out, that would be wonderful. But ultimately, on this chart, it doesn't necessarily present as a whole heck of a lot of an opportunity. I suppose we could talk about it about the 50-day moving average, but it doesn't quite present as the type of trend that some of you traders might be more comfortable with. Here's another one that made the list, was Las Vegas Sands. And that's a little bit better. You know, you've got a bull flag that resolved that way, right? There's one. So there's that channel to the 20-day, and it rallied, made a new high, and it's kind of doing something similar now, maybe a little less clean, but it is sitting on the 20-day moving average. And, you know, I got to be honest, I can't help but notice that the RSI made a lower high with the last peak, and now it's trending a little lower. So it's the lowest that the RSI has been. So that kind of stands out. Doesn't mean it has to hold up, but it also doesn't maybe give traders, you know, the exuberant feeling that they might be looking for. I can definitely share this scan, y'all, the 20-day moving average pullback. Happy to share it with you. Just make note, this is defaulted to looking in the S&P 500, but don't forget, you don't have to stay there because you can go into any of the other public stuff. So if you want to scour the Russell 2000 for these type of pullbacks, we can. If you want to get into the NASDAQ 100, we can do that as well. But I'm happy to share that with y'all. So let me just take a quick, let's go right to here, share. All right. Now, please remember, and any detail we share like this, these are not guarantees for timing or for accuracy. They are not a recommendation for your usage. All right, there you go. The 20-day moving average pullback. So a couple more that might stand out there. Now the other one I was trying to get to was something that one of my viewers in this class in particular has been helping me with was, the idea of a confirmed support test, utilizing something like what I refer to as the Horner rule, which is basically just my defined level of confirmation, looking for stocks who have held lows over a period of 3 days. And unfortunately, I couldn't find anything in the S&P that validated that. If I change this to the NASDAQ, let's do the Russell 2000 since I'm there. Let's see if I can find any, nothing at the 20-day either. So all this was doing is looking for pullbacks to the 20-day moving average where it's held that basic level for the last 3 sessions, ultimately looking as though we've had an abatement to the selling. The selling has run its course and looking for a bounce thereafter. Didn't present in the S&P, didn't present in the the Russell 2000, and let's see if it does present anything for us here in the NASDAQ 100. Unfortunately, no. So this is the kind of thing I was talking about at pre-show was, hey, some days we've got to work our way through a number of key scan details. I can suggest that in doing so, you could find yourself simply relying on the watch list you've built for yourself. My after the close watch list is nothing more than me adding stocks to it from every class. So every time we do a new trade or a new example trade that is, or find some intriguing charts, we throw those into my after the close. So while some of you might be comfortable with scanning to locate those very specific scenarios, others might fall more comfortable with the idea of just simply working through your chart. And we can do that through looking at just kind of moving our way down the list, right? QBTS rallied into the 50-day moving average, taking a breather. It hasn't popped through the 50 days. Some traders would be patient. Wait, can we get through the 50-day? They might buy on a breakout. Oscar, mired, and just kind of all over the map. That's not a trending chart. We'll keep moving. Here is AST Space Mobile. That's an interesting one today. Why is it interesting? Well, it stands out for me. Let me show you something. I'm going to zoom in. Here we've broken a downtrend, right? So we can see that we've broken that. But in the midst of breaking it, we had 3 beautiful candles to the upside, all of which came back above the ever important 50-day moving average. And here is the kind of action that some of you are going to be looking for. 3 days above an area of former resistance, now considered potential support. Now, the other thing that stands out here are 2 days in a row with the lows intraday much lower than the close. So intraday low yesterday was 70.75 and the close ended up at 74. Today the low 69.82, the close 72.84. That's why we've got those nice tails. But the tails tell us something. They tell us that there was a demand to buy as we made those tests of that approximate 50-day moving average, which resides just around $70 a share. So some traders could certainly look at this ASTS as an opportunity just based on the fact that what we've got is a 3-day period of holding a breakout level. Now, we know that doesn't mean it has to hold it, right? We have to admit if we got pushed back or closed below the 50-day, that's entirely possible. We might need to build in an exit strategy that's not tight to the 50-day moving average, but maybe, a percentage below the 50-day moving average. Some traders will use a default percentage, maybe a 2% below a moving average or 5% below a moving average. Other traders, and I'm speaking about buying just underlying stock here, they might also choose to incorporate something like the average true range. So why don't we do this? Let's go ahead and just make an example trade incorporating average true range so that we can build an exit strategy to get kicked out of the trade if it falls too far beneath our comfort here, too far below the 50-day moving average. And if it doesn't, we can just stick with it. So what we'll build is a long equity share purchase with a stop order beneath us And we'll see if we can get it to move in our favor and start rallying further. And maybe we can, over the course of the next few weeks and months, maintain the underlying shares and simply go through a process each week of raising and elevating our stop order, our exit plan. So let's talk about that. Our 50-day moving average is at the 69.90 level, okay? And we're going to consider buying just a round lot, 100 shares for tomorrow's market. We're going to have to use a bit of a padded limit to do that, meaning the asking price at this point, go to my order entry here. Well, I guess I don't need to. I can just right click in here. Let's just do it. So our last trade was 72.84. So we might have to give a little bit of an elevated limit, right? A limit price higher than our close today to increase the likelihood that we can get this trade put on come tomorrow morning. Now, just for our purposes, I'm going to explain briefly. Yes, many a trader here today would just say, I'm going to go to the extended market and go to the after hours. I'll go ahead and pick it up and then I'll worry about it tomorrow. But for our purposes, we're going to place the trade for tomorrow's business as though we don't have the interest or maybe the opportunity to utilize the extended hours. So that's the reason for the so-called padded limit. We're going to give ourselves a little bit of wiggle room. So if the stock opens up a slight bit, we can still put ourselves in the trade. Now, the average true range, otherwise known as ATR, is one of my studies that I incorporate along my toolbox up here. I'm going to add that at the very bottom. So what is ATR? ATR is simply looking at the last, by default, 14 trading sessions and giving me the average low-high spread for those 14 sessions. Today, if you look in the lower left corner, it appears to be $5.70. I'm going to simply round that up $6. So to $6. Now that means I'm putting on a fair bit of risk here because if I want to buy 100 shares at 73, let's say, and I'm going to incorporate the $6 ATR, I'm not going to incorporate it from my entry price of 73, but rather from the 50-day moving average of 70, okay? And the reason there is I want to be taken out on what a trader might consider to be a legitimate break of the 50-day moving average. Now, that doesn't mean the trend is over, but this allows the trader in their minds to build a trade with a proper amount of comfortable risk, a willingness to lose on the trade that has been defined. And when we look at where our upside resides, we are hopeful that our risk factor is about 1 to our profit factor of 3. So if we are entering at 73 and we have a chance to go to what is our high close in here? 94.5, 95 and change, and 89. So let's say we're looking at about 94. Well, if we were looking at 94 from an entry at 73, we're looking to make 21 points to the upside. And if we're willing to risk between 6 and 7 from our entrance, well, then that puts us at a 1 to 3 risk versus reward. So that could work out from a standpoint of a proper risk reward ratio. So that's what we'll do. We'll do this as a means of something to track and monitor for us going forward. So with our 50-day being at 70, we're going to go 6 points below it. That gives us an exit or a stop order at 64. So we'll be risking about 9, I guess, as it were, to make maybe 21. So we're still at a better than 2-to-1 reward versus risk. So here's how we'll set that up. We'll go ahead with an entrance with buy and custom. We're going to do a stop. We will not do a target exit on this, but we are going to do this for tomorrow's day only. So if we do not buy the stock tomorrow at our limit of $73 or cheaper, well, then this order will not be maintained, okay? And then our stop will be at 64, but we don't want to go to the round figures like that, so we're going to go beneath it down to about 94. Why not? Just give us a little bit of wiggle, okay? So we're risking a little bit more than 9 points if we put ourselves in it. Now, remember, 73 is the highest amount of money we'd be willing to pay on a per share basis to buy these shares. But if it opens at anything under 73, we're going to get the lower price. So we're not locked into 73, but if we buy it, it won't exceed $73. Now, last note about our stop order. Remember, it's a trigger price. At 63.94, it becomes triggered and we get a market order to sell thereafter, which means we're not guaranteed price in any way on our sell. So we have gap risk. So if we bought tomorrow and let's say we buy tomorrow at 73 and we hold the stock and it doesn't come down to 64, but on Friday morning, the open for let's say there's bad news about it, or the CEO perishes in an airplane crash or something like that, the stock opens much lower at $55 a share. That would be the trigger. And we'd have a market order to sell, and it would execute pretty close to 55 in my example, not close to 64. Okay, so there is risk with a traditional stop order. We have to be aware of that. Now, the key here is my buy order is good for tomorrow only, but my stop is good until canceled. That way I'm protected for the 6-month window, excuse me. All right, so I'm going to put that one on for us. And then I wanted to look at a couple that came up on my uptrend oversold scan, everyone. So let's put my details back in here. We're going to go back to scan. And this is one that a lot of traders have leaned into as well. And the reason is uptrending, you're finding stocks that are already making higher highs and higher lows, but in the short run have come down and could be considered to be oversold. Now, when I did this originally, everybody, today, I did so by trying to be very clear, looking for technology, because tech was at the top of my relative strength scans. However, that's not what I got when I scanned in the S&P. So check this out. We're going to scour for uptrend and oversold in the SPX exclusively, no delineation of sectors. When I do that, I get a few. Oh, of course, now it's going to give me 30. That's so lovely. That's hilarious. This is not what I got today when I did all my pre-work. So amazing. So I've got a whole bunch of stuff. Let's quickly do this. Let's sort by sector, and we'll see that the biggest of these groups, okay, there you go. I've got one technology stock in there, everybody. Akamai Technologies is the lone tech stock in the list, but a lot of healthcare considered to be oversold. And then there's an industrial in 3M. In fact, 3M kind of made my list. Let's look at 3M here real quickly, everybody. We're going to click on that 5 and send it to my chart. Aha. Okay, so 3M, it looks a little intriguing, right? What do we have? Well, we had a bit of you could draw the line kind of like this, right? So this is a little bit intriguing to me, because ultimately what you had was, outside of our tariff tantrum period right here, all of this, we basically held a lot of this channel level, kind of like so. Maybe I could reposition that. Either way, what stands out to me is this action up above. We have just tried busting out to new all-time highs. In fact, you had that one-day candle where we really gave it a go. Didn't happen. We got pushed all the way back to the 50-day moving average. But that 50-day moving average, once more, provides traders an understanding where the trend might change. So let's just double check this on a weekly here, everybody, to make sure we're in good standing. Oh, okay. Well, let's just activate and extend this. Let's do this too. We got, my friend Ben Watson likes to say, always look left to confirm right. You can start to understand why 3M paused up there at 172. Not necessarily why it got thrown back, but why it was so important to get through it. I mean, first layer of next resistance is about 5 points up there, 183 or so. But seriously, through this 172 could very well become opportunity, right? So this is a little bit intriguing. It's not already in the midst of that breakout, but what it is doing is giving traders that comfort once more. So this might very well be a spot where you traders would look to do something like we just did with ASTS. Maybe a trader takes a long equity position here, not sure if the breakout's coming. Long shares, they can take it up for maybe that 7-point rally, right? From the level we're at today at the close, 165 up to 172. Maybe they're just trading the range. However, if you get through, let's go ahead and recolor that since it's resistance. If you get through 172, some traders might look at that and say, goodness, I want to build a long call spread thereafter, right? That's a possibility. All right, so I wanted to look at 3M with you guys. Let's take a look back at the scan tool. And the other one I wanted to look at, oh yeah, Wiley, we can share that with you. Hang on. Let's go ahead and do that. Let's just take this share scan query. All right, so once more, everybody, this is considered uptrend and oversold. And it's in the SPX specifically. So if you want to get definitive, make sure you go through and define your individual groups. Like I said, today, when we did it, we found healthcare to be kind of a notable standout, right? Lots of the, it looks to me like about a third, if not more, of what we're getting on this scan is falling into the healthcare space, which kind of stands to reason. I mean, if we go back and look at what healthcare is doing at this point, it was a strong leader. It's in the midst of pulling back. Where's it going to pull back to? Well, that green line becomes a pretty important one. See, we've gone pretty aggressively lower over the last 2 weeks here, but healthcare was a leader to the upside and it was volatile to the upside. We have to expect some volatility on the pullback, and that's precisely what we've seen there. So I thought that was notable. The one I wanted to look at in here in healthcare was HCA. We talked a little bit about how that one made the list earlier. So here's healthcare, HCA, hanging in at the 20-day. And what stood out to me is that last 3 sessions or 4 sessions really offering support with all the lows coming into play. So this hasn't given you a hold just yet, has it? But it's coming close. What it has done, even though you don't have a hold, a close above the high of the low day, it has solidified support, at least such that a trader would say, if it closed under 483, a trader is likely to say, I need to cover some, or I need to pull some off, or risk running it down for 25 points to the 50-day moving average, approximately around 460, 461. So you got to be thoughtful about that, right? But if the trader were confident, about this level, they might look at this as an opportunity to build a bull call spread and speculate to the upside, maybe targeting the prior high close. The high close here was at 515. Yep. So basically, if we targeted 515 for a trade, some traders might look at this and say, yeah, I could get it to 515. But when you're building a call spread, what a lot of traders like to consider is what's a level under those targets that I could use for the short side of my call spread. The idea being we buy a contract that is in the money, under support, so that we get a better delta valuation on our option. And we sell a contract at a level below the ultimate target zone because we want to increase the likelihood that we get the opportunity for our trade to work in our favor. So, if we were looking at here, it might be something like a 480 call, and instead of a 515, it might be like a 510 or even a 505. I mean, a 480 to 505 would be a $25 spread, and that surely could work. In fact, that's one way to give thought to it in terms of monitoring or looking for the option detail. That's where a trader is going to get a little bit into the weeds. They want to see what's the delta detail, right? I said 480. Look at the delta at the 480, 65. So that's a 65% likelihood of being in the money at expiration, which is still 10 days out, a week from Friday. So that's a win. That's a positive for the long bullish, the bullish long call spread trader here. And then conversely, if we're buying a 480 and selling a 505, look at the delta there, only 24 cents. So this is a very low likelihood of being in the money at expiration, much less than the 480 does, right? So by doing this, we have a chance to reduce our cost we basically finance portion of our purchase for the call option by being willing to cap our upside at 505. Some of you would say, I'll take the extra, $150 or almost $200 and take it off at 500, do a $20 spread, and might work with it like that. Let's see how this looks at it that way. So buying the 480 and selling the 500 tells us our net debit is about 10.5. That's probably 11, at least 11 to get us into the trade, since again, we're overnight and we can't know what the stock's going to look like tomorrow. But if we were putting ourselves into a $20 long spread and it cost us 11 to put it on, we could make 9 from that trade. And all we would need would be to be above at expiration on the 19th, to be above 500 to get our max gain scenario opportunity. So we could look at it like that. Okay, so that's one to for consideration. In fact, we'll go ahead and put that one on as an example trade for us so that we've got something to track next week as well. It's going to be short order. It's only going to come basically next week is going to be the opportunity, unless we kick this out to the next series, which would be to January. And we could do that. And just for the heck of it, let me just see how this changes our values. Actually, it really doesn't change everything all that much, does it? 480, 24, 500. Yeah, our mid is still in that vicinity. We could still put that on for about 11. Why don't we do that? Let's just give it a little bit more time to work its way through. So again, we're just looking to make the difference here. As long as we get through and above 500, which is really only a 13-point move, we could perhaps do very well on that. So let's give that a shot. Let's see if we can get into that trade for an example trade for tomorrow. Here's our risk situation. Like I said, our max profit of 900, our max loss, what we spend. But remember, as we'll see here momentarily, we don't have to carry all of these trades all the way through. Okay. So we'll put on that example. Now let's go to our example portfolio and let's talk about a couple of these trades. So here's our unallocated trades ready to get added to my after the close drop down tomorrow at some point. We've got a winner working on Caterpillar. We are in a 530, 580 call spread, long call side of that. Everything's working in our favor because as we'll see here, let's go to the chart. Here's Cat. So we are already above our levels, right? So we built a 50-point spread and it's worked in our favor. We are already through the short contract at 580, right? So 580 call. So we are at risk for delivering stock at 580, but there's nothing wrong with that because we've got the purchase opportunity at 530. And if we just simply let this go until January, well, we're going to walk away making our best case, essentially, assuming we don't do anything with the options themselves. Now, there is value remaining in these contracts here. And so as an example, we can still sit on this position. We can also choose to close it because we've not made our max, but we have made a big chunk of our expected opportunity here. So, we don't have to leave this one as is. We've got a long time to go, more than a month. Let's go ahead and write it out. Let's see what this looks like. And I like to do that in this class in particular if we have the time, because I want to continue to highlight the way the option works against the price of the underlying stock. Now, the 4 trade is a little interesting because it hasn't worked in our favor. We bought a long 70 put and sold the short 60. The goal being, of course, to trade 4 to the downside. Now, quickly make note of the fact 4 doesn't have a lot of market value left. In fact, it would cost us $37.50 to buy back that 60 put, which would take off the lid from our trade. What we would do, why would we want to take that off? Well, it's because the majority of the work has already been done, everybody. We build a spread because A, we have a target, and B, it helps to reduce the cost of our long put. So this contract, this short put, we sold it, and it's already managed to move in our favor by $57.50. So, could we close it? Yeah. In fact, tomorrow morning, we can go in, create the closing order, not for the vertical, but just for the short 60 put. So let's go in and place that order. And instead of at 50, let's place it at 40 cents. And let's just see if we can take the lid off there, which would give us the chance, if 4 does in fact go lower, well, now we have an even better opportunity for profit because we are long that 70 put. And so even if it trades all the way down, that could allow us to take a bigger chunk of profit than we had initially expected. So we'll see how that goes come, the remaining window of time here on 4. This one also goes out to the December 19th. So that's 10 days a week from this Friday. And then the last one in here, we just put on last week. That is the ServiceNow. This trade is not working the way that we necessarily expected. We did talk about utilizing Now and Technology Group as one to consider for a short-term bearish trade. And unfortunately, in the last week, we rallied into the 20-day, but we've popped higher. Now, we could choose to close this trade out. We're not going to. We're going to give this some time. But notice here, it tried to make a higher high. It didn't. It made a matching high. You've heard me say it in the way of trends. Matching lows are fine. Lower lows, not so great. But in a downtrend, matching highs may very well represent resistance in this case. And the fact that we remain below the 50-day moving average, even though we're above the 20, look at how porous the 20 has been, meaning we've been above it, we've been below it, above it, below it, above it, below it, etc. over the last few months. The 20-day is not the strongest trend scenario here. The 50-day a little better, but also a little bit choppy and porous. So the reason we're not going to make any alterations to the trade here, 1, time frame. I want to give it another week. Potential exists for this downtrend to continue. And 2, well, we put on the trade, and when we put it on, it was with an approximate amount that we would be comfortable losing. Okay. Ultimately, I'm sticking with the research we did. All right. So that's why we're sticking with the ServiceNow. So there you go, everybody. We covered quite a bit. Exactly. Great point, Mike. Matching highs equals resistance. The same way matching lows equals support. That's an okay thing. And when we're watching a downtrend, resistance being maintained can tell us quite a bit about the existence of the downtrend continuing, perhaps. So we're going to go ahead and wrap things up there, everybody. More to get to as we'll look at this next Tuesday. We'll look at the example portfolio once more. We, of course, will look to see if the trades we've put on for tomorrow execute and carry us further. But thanks for being here. Don't forget to follow Mike Fairborn and me on X. Also hit that thumbs up button down below if you like the discussion today. But don't forget as well, we do have our upcoming 2026 market outlook this week, everybody. You're going to be hearing from the Schwab specialist, Joe Mazzola, Liz Ann Saunders, and so forth. They're all going to be available to cover the expectations for 2026. Make sure that that's on your calendar, everybody. I really appreciate you joining me today. Thank you so much for being here. I will be back with you tomorrow morning for Trader Talk. That is at Market Opens, 9:30 a.m. Eastern. I hope to see you all there. Have a great night, everybody. See you again soon.